welcome back to the channel. It is December 2025. The holidays are upon us. The snow is starting to stick to the ground here in Toronto. And if you are reading the headlines, you are probably more confused than ever. We are closing out the year with a market that feels incredibly contradictory. Depending on who you talk to, or where exactly you look, the market is either crashing, correcting, or surprisingly resilient. Everyone says the market is in trouble, but the data proves that the City of Toronto core actually up to 0.6% this year. So, let me explain exactly why that is happening and what it means for your wallet as we head into 2026. Let's start by looking at the headline figure that everyone quotes. The average house price across the entire region is currently sitting at $1,056,682. On the surface, that looks like a big, stable number, but averages lie. They hide the nuance of what is happening on the street level. If you are sitting in a condo downtown versus a detached home in the suburbs, your reality is completely different this December. We have a situation where the City of Toronto, the 416 area code, is showing surprising stability. In fact, we are seeing numbers suggesting that the core is holding its value and even appreciating slightly, while the wider Greater Toronto area is facing a much steeper decline. We are seeing a divergence that we haven't seen this starkly in years. The city is acting as a shield, while the suburbs are feeling the full weight of the correction. This is crucial because if you treat the GTA as one big monolithic market, you are going to make a mistake. You cannot use suburban logic for a downtown purchase right now, and vice versa. We also need to talk about the supply. We are sitting at 4.9 months of inventory. In real estate terms, anything around 5 months is considered a balanced market, tipping slightly towards a buyer's market. But it feels heavier than that. It feels slower. And that is because we are in December. The seasonality of this month always distorts the data. People are busy buying gifts, not houses. They are worrying about holiday travel, not mortgage pre-approvals. But beneath that seasonal slowdown, the fundamentals are shifting in a way that is going to set up a very explosive spring 2026. Today, I am going to walk you through the price paradox between the city and the suburbs. We are going to do a deep dive into the inventory freeze that happens every winter and why this year is different. We are going to analyze the Bank of Canada's massive move this month, cutting rates yet again to 3.25%, and why buyers are still on strike despite that help. This is your comprehensive end-of-year deep dive for December 2025. Let's get into the numbers. The price paradox, city resilience versus GTA correction. Let's begin by unpacking what I call the price paradox of late 2025. Usually, when the market corrects, it corrects everywhere. A rising tide lifts all boats, and a falling tide usually grounds them all. But right now, we are seeing a split personality in the data that you need to understand if you are planning to transact in the next 90 days. Let's look specifically at the City of Toronto. The data for the city shows an average sold price of $1.1 million. But here is the shocker. That represents a 2.6% increase year over year. Think about that for a second. We have spent the last 12 months hearing about affordability crises, mortgage renewals, and economic slowdowns. Yet, in the heart of the city, prices are actually higher than they were in December 2024. If we look at the quarterly trend, it is even more pronounced. The City of Toronto has seen a 5.2% positive change over the last quarter. This suggests that the demand for the core 4 being close to the office, close to transit, close to the amenities has returned with vengeance, or at least with resilience. Now, compare that immediately with the broader GTA stats, which include the suburbs like Durham, Peel, and York region. The average price there is $1,039,458. That figure represents a 6% drop year over year. So, if you move just 20 minutes outside the core, you enter a market that has dropped 6%, while the core has gained nearly 3%. That is a delta of almost 9% in performance based solely on geography. Why is this happening? During the pandemic years, we saw the drive until you qualify phenomenon. Everyone left the city for space. Prices in the suburbs skyrocketed disproportionately. What we are seeing now, in December 2025, is the unwinding of that trade. The suburbs are giving back those massive gains faster than the city is. The city didn't run up as hard in 2022 relative to its fundamental value, so it isn't falling as hard now. Furthermore, let's look at the benchmark price. The GTA benchmark price is now $951,700. That is down 5.8% annually. The benchmark is often a better metric than the average because it removes the skew of luxury mansions or teardowns. A nearly 6% drop in the benchmark price for the GTA confirms that the typical home, your standard suburban townhome, are losing equity. This is painful for sellers in the 905 area code who bought in the last 3 years. They are likely underwater or breaking even. So, the narrative that the market is crashing is true if you own a townhouse in a distant suburb that saw 50% appreciation or the pandemic. But if you own a semi-detached home, a prime Toronto neighborhood, the narrative is totally different. You are seeing stability and even growth. This paradox is the most important thing to grasp right now. The geography of this correction is not uniform. If you are a buyer, this tells you where the deals are, the suburbs. If you are a seller in the city, this tells you that you have more leverage than the headlines would have you believe. Inventory deep dive. The winter supply freeze. Now, we need to talk about inventory, because price is just a function of supply and demand. And in December, supply gets weird. We are currently in what I call the winter supply freeze, but there is a very troubling undercurrent to it this year. First, let's look at the flow of new listings. Month over month, new listings have dropped by a massive 30.3%. Sellers pulled 30% of the potential products off the shelves in November and December. This is entirely normal. It is seasonal. Nobody wants to host an open house during a blizzard, and nobody wants strangers walking through their living room when the Christmas tree is up. If you are looking at the new listings data alone, you might think supply is tightening up. You might think, oh, there is nothing to buy, so prices must go up. But that is a trap. You have to look at the total active inventory. Despite that massive 30% drop in new listings, the total number of active listings in the GTA is sitting at 24,549. That number is up 12.5% compared to this time last year. Let that sink in. We have fewer people listing their homes this month, but we have significantly more homes sitting unsold on the market than we did a year ago. The bathtub drain is clogged. The tap has been turned down. New listings are low, but the water level in the tub active listings is still high. This accumulation brings us back to the months of supply metric, which is currently at 4.9, almost 5 months. This is the highest level of inventory relative to sales we have seen in quite some time. It signals a balanced market, but one that is teetering on the edge of a buyer's market. When you have 5 months of supply, buyers have time. They don't have to rush. They can view a home, go home, think about it for a week, come back for a second viewing, and negotiate hard. The fear of missing out is completely dead in this market environment. We also need to contextually understand why this inventory is sticking. It is not just junk listings. There are good homes sitting for 60, 90, 120 days. This is creating a backlog. As we move through December and into January 2026, those 24,000 listings aren't just going to disappear. They are going to be joined by the new year. New listings in January and the spring rush in March. If we don't clear this inventory out soon, we are going to see inventory levels spike to 6 or 7 months of supply by February, which would put significant downward pressure on prices. So, do not be fooled by the drop in new listings this month. It is a seasonal illusion. The reality is that inventory is piling up year over year, and the competition for sellers is fiercer than it has been in a decade. If you are a seller right now, you are not just competing with the neighbor down the street. You are competing with thousands of other stale listings across the GTA that are desperate for an offer. The interest rate pivot, box December move. The biggest news of December, and the factor that everyone is pinning their hopes on for 2026, is the Bank of Canada. We just received the December decision, and it was a big one. The Bank of Canada cut the overnight rate by a half percentage point, 50 basis points, bringing the policy rate down to 3.25%. We need to step back and look at the trajectory here. This marks the 5th consecutive rate cut since June 2025. We have come down significantly from the highs. The central bank is clearly signaling that the war on inflation is over and the war on recession is in full swing. They are cutting aggressively because the economy is softening, and they know the housing market is a huge part of the Canadian GDP. Earlier in the year, the bank discussed a neutral rate target of roughly 2.25% to 2.5%. We are currently at 3.25%. That means we are getting closer to neutral, but we are still in restrictive territory. The money is still relatively expensive compared to the free money era of 2020 and 2021, but it is vastly cheaper than it was in 2023 and 2024. However, there is a psychological component here that is fascinating. We have hit 3.25%. Is this the magic number for a loss of buyers? The answer seems to be not yet. And here is why. The stress test. Even with a rate of 3.25%, you are stress testing at 5.25% or higher. That still caps borrowing power significantly. But more importantly, there is a lag effect. Rate cuts take 12 to 18 months to fully filter through the economy. The cuts we got in June 2025 are only starting to be felt now. This December cut won't be fully felt until the end of 2026. So, will this 3.25% rate trigger the pent-up demand immediately? Probably not in December. Who wants to get a mortgage 2 weeks before Christmas? But it sets the table. It changes the math for investors who are cash flow negative. It helps first-time buyers qualify for a slightly better townhouse. It signals to the market that the worst of the pain is behind us. The danger, however, is the expectation of more cuts. If buyers believe that rates will drop to 2.5% by next summer, why would they buy now at 3.25%? This is the double-edged sword of a rate-cutting cycle. Sometimes, buyers sit on their hands waiting for the absolute bottom in rates, just like they wait for the bottom in prices. But make no mistake, 5 rate cuts in 6 months is an aggressive pivot. The Bank of Canada is trying to reignite the housing market, and historically, when they push this hard, the market eventually responds, usually violently, to the upside. Buyer psychology and volume. The standoff. This leads us directly into buyer psychology and the transaction volume, or rather, the lack thereof. We are witnessing a standoff, a staring contest between buyers and sellers. And right now, nobody is blinking. Let's look at the volume numbers. Sales in the GTA, down 14.7% year over year. In the city of Toronto specifically, sales are down 15.8%. That is a massive collapse in volume. We are seeing transaction levels that are reminiscent of the Great Financial Crisis or the early days of the pandemic lockdown. But this isn't caused by a lockdown. It is caused by a psychology of fear and anticipation. Sales volume has collapsed by nearly 16%, not because buyers are broke, although affordability is tough, but because buyers are effectively on strike. They are waiting for the bottom. We just discussed how the benchmark price dropped 0.5% month over month. As a buyer, if you see prices ticking down every single month, your incentive is to wait. Why buy today for $1 million when it might be $990,000 in January? That logic is incredibly powerful, and it freezes the market. Buyers are looking at that 3.25% rate and saying, "That's nice, but prices are still falling." They are looking at the inventory of 24,000 homes and saying, "I have plenty of choice. I don't need to rush." This is the wait and see approach entering 2026. It is a very rational approach, but it creates this eerie silence in the market. We have to connect this volume drop to the price drop. Prices are falling because volume is low. Sellers who must sell due to divorce, death, debt, or relocation are lowering their prices to find one of the few active buyers. The discretionary sellers, people who just want to move, are pulling their listings or refusing to drop their price, leading to the stalemate. So, as we sit here in December, the bear psychology is dominated by caution. There is no urgency. Real estate agents are calling leads and hearing, "Call me in the spring. Call me after the next Bank of Canada announcement. Call me when prices drop another 5%. This accumulation of deferred decisions is building up a reservoir of demand. These people didn't stop wanting homes. They just stopped wanting to buy today . And that reservoir is filling up, drop by drop, waiting for a catalyst to burst the dam. 2026 forecast and strategy. The spring coil. So, where does that leave us? How do we strategize for 2026? We have analyzed the low sales, the lower rates, and the high active listings. When you mix these ingredients together, 3.25% interest rates, plus almost 5 months of supply, you get what I call the spring coil. The market is coiling like a spring. The tension is building. On one hand, you have inventory pressing down on prices. On the other hand, you have cheaper money pushing up on affordability. Something has to give. My forecast is that the 3.25% rate will interact with the 4.9 months of supply to create a very distinct floor in the market, likely in Q1 of 2026. Let's look at the strategy for buyers first. The data, specifically fact number 2, showing a 1.1% monthly price change in Toronto, suggests the bottom might already be in for the 416 area code. If you are looking to buy in the city, waiting until March might cost you money. The recovery is already showing green shoots in the core. The strategy should be to act while the suburban correction is distracting everyone. You have a 90-day window here: December, January, February, where sellers are demoralized, inventory is stale, and rates are decent. This is your window to negotiate aggressively. Don't wait for the headlines to say market recovers, because by then, you have missed the bottom by 6 months. Now, for sellers, if you are selling in the GTA suburbs, you are navigating a 12.5% increase in competition. You cannot price your home based on what your neighbor got in 2024. You certainly can't price it based on 2022. You need to price ahead of the market. If the benchmark is dropping 0.5% a month, you need to price 1% below the last comparable sale to look attractive. Your strategy is speed. You do not want to be sitting on the market when those new year listings flood the system in January. If you are on the market now, get it sold. If you are planning to list, you need to ensure your home shows 10 out of 10. In a market with 5 months of supply, buyers punish mediocrity. If your home needs paint, paint it. If it needs staging, stage it. You are in a beauty pageant with 24,000 other contestants, and only the prettiest ones are getting the roses. For 2026, I predict a slow start in January and February due to the weather and the hangover from 2025, followed by a sharp uptick in activity in late March or April, as a cumulative effect of 5 and likely 6 or 7 by then rate cuts finally pushes buyers off the sidelines. The coil will spring. The question is, will you be positioned correctly when it does? Conclusion: the window of opportunity. To wrap this up, let's summarize the window of opportunity that lies before us in this final month of 2025. The data is clear. We have a massive divergence. The GTA suburbs are clearly a buyer's market, down 6% year over year. There are deals to be had there. The city of Toronto, however, is stabilizing and showing early signs of recovery, up to 0.6%. This means the window to snag a deal in the core is closing faster than in the 905. We have the Bank of Canada marching clearly toward a neutral rate of 2.25%. We are currently at 3.25. The trend is your friend, and the trend is lower rates. But remember, by the time rates hit the bottom, prices will have already moved up. You never get the lowest price and the lowest rate on the same day. You have to choose one. As we head toward the December 1st MLS stat release and close the books on 2025, look closely at your own situation. Are you paralyzed by headlines? Are you waiting for a perfect moment that doesn't exist? The winter market is dark, cold, and often depressing, but it is also where the smartest money is made. Institutional investors and savvy buyers love December because there is no competition. While everyone else is at the mall, you should be at an open house. Choose your location wisely. Understand that the city and the suburbs are onto different timelines right now. Stay warm, enjoy the holidays, but keep your eyes on the data, because 2026 is going to be a very different animal than the year we just left behind. Thanks for watching, and I'll see you in the next deep dive.